Okay, hello everybody, and welcome to Investing with IBD for October 30th, 2019. I'm your host, Arusha Paris, and with me in the studio, or not necessarily in the studio, out there in the ether today is Bruce Fraser, longtime professor of Golden Gate University and expert on one of the pioneers of technical analysis, Richard Wyckoff. Great to have you, Bruce.
Great to be here. Thank you.
On today's podcast, we are going to talk about the current markets, having the patience to wait for the right moment, and we will talk about current stocks. So let's get into the current market. Right now, we have the market in a confirmed uptrend. The indices have hit new highs this week. We have 4 distribution days on both the NASDAQ and the S&P 500. So the markets are at new highs, but still a little choppy. But underneath, stocks are starting to set up a little bit more. And as always, the last few months, the market has continued to be resilient. Bruce, what are you seeing in this market right now?
Well, I'm very bullish. I've been bullish really for the last 3 or 4 months, and I've written a number of blogs expressing that idea, largely from this notion of the financial repression, which is that we have these very low interest rates. These low interest rates have made the stock market really a very attractive place to be. And it's put, I think, a bid under the stocks that have value and income. And I've written about this recently, but I believe that we have rotation taking place away from growth and towards these more, there's a number of terms we can use: cyclical, value, income, et cetera.
Yeah.
But that we're moving. Money is starting to migrate towards those areas, and that isn't to say that growth is not going to be a good place to be. It's just I don't think where the attention is going to be on the in that segment of the market for at least a little while, and you can really see it in the way the relative strength is setting up and de-emphasizing growth and emphasizing these other areas.
And what is some of the sectors that you're seeing that are starting to get that relative strength and starting to benefit from that rotation?
Well, you can really see it in the industrials. You can see it in banking. You can see it in pharma. I think that some of the more deeper value areas, a couple of the stocks we're going to look at today, hopefully, represent areas that are just more value oriented and have yield. And so I think that would be the emphasis, is to look at where the yield is. And it doesn't have to be particularly high yield. I think that it's just stocks that have the ability to be able to consistently produce yield and grow their yield. And it doesn't have to be high, but I believe that there could be tremendous appreciation in those stocks. And so there's a number of sectors. The consumer sectors have those attributes. Industrial sectors, we can see it in the utilities. We can see it in communications, et cetera.
And that's perfect. And what's always interesting, and we'll definitely talk about this more in the episode, is you're getting all this insight from just analyzing the charts and relative strength. And that's the beauty of these strategies, of using technicals to lead you in the right direction.
I am a pure technician. I am totally old school. The one thing that I do, that, because I feel like I've come home here. It's I've returned back to my roots, because if we go all the way back to the sort of the beginning of my career, the first place that I landed was at William O'Neill. And so to land at William O'Neill and be able to study CAN-SLIM and technical analysis and growth characteristics, I have taken those attributes for my own, and I use them as all of us acolytes of Can Slim, and I'm a daily graphs guy. I've
Yeah.
got, back, I think I got my first daily graphs book in 1981.
And so just to make clear for those who are a little bit newer to our system and really to our products, the daily graph, you're talking about these old daily graphs chart books that were printed every week for both the NASDAQ and the New York stocks, and they were delivered to you for years and years, and that really gave you the edge in the market.
And I had those books in my grubby little hands all week long until the next books came.
Yeah.
And I would like go around with them. And if I had 1 second of extra time, I would be have my nose in those books, looking at those charts. It's just fantastic. And I think, MarketSmith is fabulous. And it's certainly a very important go-to service for me, and it is the electronic version of that. And how I sort of recreate that today is I take my iPad around.
Yep.
And I'm always in my MarketSmith app on my iPad looking at those.
Yeah, and a lot of it is just looking at enough charts, getting that insight on what stocks are setting up, what stocks are near new highs, and what stocks are showing that relative strength.
Absolutely. And I just think it's just a great service for that.
So let's get into a little bit more of your background on how you got started. And we'll hold off on some of this because we'll save this for segment 2 because it's just a great story. But your family business, it was horse racing, and you were thinking about going in that direction, but during that time, as you were learning about, you wanted to learn more about finance, and so you ended up going to Golden Gate University, and that's what kind of exposed you to the market and technical analysis.
Well, exactly right. And I had, when I was very young, I started going to the racetrack with my dad, and we worked. Now this is Northern California, and we would work at different tracks depending on where the meets were. And I was like 6, 7, 8 years old, and I just couldn't get enough of it. I wanted to go to work with my dad, work at the track, and I just fell in love with it. Mm-hmm. And so I had spent literally my whole career. This is what I got. It's the job that got me through college. It's where I kind of learned how, sort of the lessons of life was through being at the track. And I had all these great friends who were all adults. I'm a kid, and they all wanted to, teach me the rules of life via the racetrack, which, I'm not sure, but that's the truth of it. And, but I learned a lot. And as I look back on my career growing up, and I did all the different jobs, you could imagine all the jobs at a racetrack. Well, I did a lot of them. And so I would do any work I could get. But the thing is that as I look back on my investing career, the lessons I learned being around horse racing and handicapping really, really did inform my career as a trader, as a speculator, as an investor. And it really, as a matter of fact, I had developed, when I was at the track, I noticed that most people lose money at the racetrack. And I'm watching these people handicapping horses, and I'm realizing that this is not a game that's easy to win. Yeah. And so as I got a little older and I kind of liked math, I started doing sort of simplistic analysis on probabilities and regarding handicapping and horse racing. And later on, that really served me well when I became a stock market person. And so I had developed a lot of my sort of probability thinking really from the racetrack as a kid. And that was really important to me because the one thing I learned from doing that research and work as a kid was not to play the horses.
Yes.
And so that was one of the big
That's a
things
good
I
lesson.
learned.
That's definitely a good lesson to get.
I learned a lot about the VIG how much money gets taken out of the handle
Okay.
on each race during
And
the
that's
day.
the track just taking their cut, right?
Taking their cut. I learned a lot about how to evaluate the VIG in speculating in stocks,
Yep.
and how to understand the costs of trading, and the importance of minimizing those costs as a way to be able to create consistent results. And so this was very important to my education.
Perfect. So let's take a quick break here, and then we're going to continue with this story because Bruce learned a bunch about horse racing, but then also realized that, okay, maybe this is not necessarily the path. But when we come back, we're going to learn where his path took a dramatic turn when he started to go as a student, as a grad student to Golden Gate University, and when he was exposed to technical analysis and Wycoff. So stay tuned. Hey everybody, Arusha here. This December, IBD is hosting the last ever Cancelim Masters program, and you don't want to miss it. The Masters program is an intensive 2-day investing workshop that can change the way you trade forever. You'll learn strategies for increasing your profits from top portfolio managers like David Ryan, Scott O'Neill, and yours truly. This event has a very limited amount of tickets available, so don't wait to buy yours. Go to investors.com/masters for more information and to save your seat. Bruce Fraser is our guest on Investing with IBD. Okay, Bruce, let's continue this story of your career, and let's talk about you were at horse racing, you grew up in the business. That's what the path you thought you were going to go, but you decided to go back to grad school and learn more about finance, and you ended up at Golden Gate University, and suddenly your whole life changed with one class and one professor.
I had decided that I wanted to go back to graduate school because if I didn't think there was any other job you could do in the world other than horse racing.
Okay.
I just thought, this is that was my world.
Yeah.
And so I go, I decided, well, if I'm going to have a career in horse racing, I'd like to be able to do everything I can to improve my opportunities to be able to get a good job, maybe be in management. And so I went to graduate school and worked on my finance degree. And while I was at Golden Gate University, which the reason I chose Golden Gate, it had a good reputation, was in downtown San Francisco in the financial district, I could commute there from the racetrack.
Perfect.
And so I went to Golden Gate. So it was a pure accident that I went there. And one of my finance professors said to me, he goes, you may not agree with the technical analysis methodology, but there's a course here that I think you definitely need to take. And it's taught by Dr. Hank Pruden. And it's a course, people like the course. He says you may not agree with the material or the concepts, but it'll be valuable for you to have this exposure. So I took the class, and I think it was the second week of class, the second night, because you go once a week, because these classes were taught in the evening. And so the second class I took, I came to the conclusion this class was so dynamic. It was so interesting. It's so related to my experience in horse racing that I said, this is what I'm going to do the rest of my life.
And how did it relate to your experience in horse racing?
Well, it was the same game. It was just bigger. Okay. Horse racing has tremendous limitations in terms of bet sizing and the handle or the pool of money that's being bet, and so on and so forth. It's just the size of the stock market just seemed infinite to me.
Yeah.
And then I started to really understand the concepts of speculating in stocks, and I realized that there's a much better opportunity to create an edge in the stock market that you cannot create in horse racing. That the costs of making a bet in horse racing are very, very high, and the costs of being able to come up with a, a low risk, low cost trading opportunity in the stock market was much better than it was in handicapping. And so I realized that it was a similar game, but it was a much better game.
Okay.
And so I was very excited about that. And then I loved, because I was very visually oriented,
Yeah.
I loved charting. I absolutely loved it. And so Dr. Pruden, who was the best teacher that I'd ever had, and ultimately we became teaching partners, and he was certainly one of maybe my most important mentor in my life. He really was an incredible teacher of the technical analysis skills, and of course he was a Wycoffian.
Yeah,
And so that's how I got my exposure to Wyckoff.
Yeah, and so let's go over some history of Richard Wyckoff. He was back during the days of Jesse Livermore, right when the stock market was really starting to get its footing there. Why don't you talk a little bit about Richard Wyckoff?
Well, Richard D. Wyckoff, he really started his career as a teenager as a runner on Wall Street in the 1800s, late 1800s. And he was just a brilliant young man. I don't think that his formal education really went beyond what we would call junior high school today, but he was just incredibly, curious and interested and intelligent. And he started to really pay attention to what was going on. And he started to see patterns in stock purchases and sales from because back in the day, they literally ran the certificates back and forth from firm to firm.
Wow.
And so he knew who the big operators were. And he started to ask the question, what are the real rules of the game of Wall Street? Because he saw, as I did in handicapping, he saw in the stock market that most people lost money. And so he's like, well, what are the real rules of the game? And why don't these people know the real rules? Why is it so hard for, normal people to make money? And he realized that there is a process by which the very, very successful, what he called composite operators, there was a way that they conducted their activities in the market. And he was a chartist. He called himself a tape reader, but he really was reading charts. Is that he developed methodologies for being able to see the footprints of the composite operator, either accumulating stock and building positions in stocks that they wanted to own and campaign to much higher prices, or they were distributing stock stealthily, carefully, and distributing that stock to the public. And when they were done distributing the stock was in a position to go into a free fall.
And you can see the parallels already, or the influences that what Wyckoff had on William O'Neill, on Can Slim, because it's very much the same language. The game is very much the same.
Absolutely. And I actually consider William O'Neill to be a classic composite operator, who also, in his own unique way, to give him credit, is someone who wanted to share his knowledge with others. He wanted people to understand the right ways to participate in the markets. And that also, I think, was part of Richard D. Wyckoff's essential nature, was that he really was concerned about the public. He wanted the public to learn the right ways to conduct their operations. And that, here's the secret, is that if you know how to do this, you can ride along with the composite operator, and it's actually easier for the public to do this than it is for the CO to do it.
Exactly. And so that provides a good segue on really waiting for the right moment, because you spoke about composite operator, the composite operators, or these days we call them institutions, building a campaign, acquiring their shares, building these bases. So let's go into one of the lessons that you've learned over the years, having the patience and waiting for the right moment to start to buy stock, or really actually start to execute your plan.
Well, and can't we all say that we've seen a really good idea, but just seen it way too early?
Right, exactly. Yeah, it's so true.
I've done that a few times.
Yes.
And the whole thing about Wyckoff, and you can go back and read my old blogs, and you can see a lot of this material, and you can see schematics about how this is visualized on a chart. But a chart is telling a story, and the story is that the chart is saying that the CO has shown up and starting to put bids under the market or under the stock, and it's creating a trading range in that stock, which ultimately is producing what we might call, in this case, accumulation. And so they are systematically accumulating shares. Think of a Warren Buffett.
Yes.
How long it must take Warren Buffett to build a position in a stock that he wants to own. It's got to take months.
Exactly, yeah.
And so think about Warren Buffett being in competition with other big CEOs that are thinking just the way he's thinking, that are also buying shares. They are very careful not to bid up the price of the stock on themselves. And so they conduct their operations in a way that they won't drive up the stock price unnecessarily. And so you can see this, the conduct of this operation in the charts. So the charts will show you the evolution from a stock beginning to make a bottom to the completion of the accumulation where the stock is now ready to go up. Mm-hmm. And why does a stock go up a lot? A stock goes up a lot because the floating shares of stock available to be purchased have all been locked up by these very large composite operators. And the only thing that is going to cause them to start to sell their shares is much, much higher prices. And so what you create is you create a shortage of stock. Stock is unavailable to be purchased. So when other institutions show up and want to own that stock, the only way they can even attempt to buy shares is at higher and higher prices. And so this is the art of the patience of waiting for that critical moment. And Wyckoff used to call it a hinge, or a pivot, where a stock is ready to go from the inaction of completing an accumulation to the action of marking up. And when stocks begin to mark up that are tightly held or have been absorbed, is the term that we use, they can go up dynamically.
And in O'Neill terms, that's the breakout right there, where all of a sudden there are no more shares available for sale at that price. And then once you have that demand continues to come in, it causes an explosion in the surge of the stock.
Perfectly said. Exactly so. And so we use the Wycoffian techniques for being able to identify individual bars and segments inside of accumulation ranges where we can see behavior changing. Because even though the CO is doing a good job of not driving up the stock price on themselves, they're being very careful to buy shares in a way that they can just absorb or accumulate. But eventually they just can't, there's no more to be bought.
Yep.
And you can see all of that behavior in the unfolding action of the accumulation range.
Perfect.
And so if you can identify those different phases of the accumulation, you can identify and you can be patient, because this is really what the segment's about, is patience.
Mm-hmm.
We can be patient and wait for that right moment when the market is ready to pivot and turn up, and we can become active and build our positions at that right moment. We don't have to do what the CO does, which is to buy all the way through the base. We can wait for that right pivotal moment on the hinge.
Perfect. Well said, Bruce. So having the patience and waiting for the right moment is the difference between having a good year and a great year. Coming up next, Bruce and I will talk about 3 stocks that are setting up in the market. We'll be back. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We are back with Bruce Fraser on Investing with IBD. Okay, Bruce, let's get into some current stocks. And the first stock is Polaris, ticker symbol PII. And this company is involved in all-terrain vehicles, snowmobiles, and other recreational type of gear. And so what do you see on the charts with Polaris?
Well, this is a great example of a potential accumulation. And we can go back into late 2015, and we can see this just wholesale decline of the stock price.
Yeah, so there's a big downtrend there, right? Yeah, so it was totally selling off right there. Yep.
Look at the volume. So we expect to see volume ever growing as prices decline. And right into the lows, you can see a climactic surge, which is immediately reversed with a pretty sharp rally. We call that an automatic rally. Now,
and so that was around January 29th of 2016. So,
right.
So, okay, at that point, I see it. Yep.
And so what we would do is we would draw a support line under the low of the climax.
Okay.
And we would label that a buying climax. We'd give it a label. And then at the top of the rally into June, we would draw a line over the top of the resistance area, and that would be the outer bounds of our trading range, of our accumulation area. Doesn't mean we can't go above or below, but typically when we go beyond the resistance area, the support area, those will be temporary moves. And so you can see that there was an attempt to upthrust in late 2017, attempt to upthrust that area. It hung out there for a while and then collapsed right back down into the support zone near the the selling climax low. And so now we have attempts to go back down, but notice this. Notice that the declines that are occurring here in 2019 are short in duration and are not going very far. So immediately they're finding support. I contend that this is the composite operators putting bids under the market and buying stock near the support areas around the area of the selling climax lows.
And so, Bruce, let me interrupt you here for 1 second. So this is what you've described right now is essentially been a 3-year kind of price and volume going back and forth, the battle between the bulls and bears, where formed one trading range for between 2016 and 2017. It emerged out of that, came back in, and then formed another one. But the key is over the last 4 months or so, the base, it's actually forming a base on Market Smith right now, and it's getting smaller and tighter, a little bit more narrow, meaning that the supply of stock that's available for sale at these prices is starting to get soaked up.
This whole area all the way back to the selling climax could very well be considered accumulation.
Okay.
And so this is very compelling. And then notice that we're pivoting. Remember the term we talked about, the pivot or the hinge?
Yeah.
So you can see the higher lows here since December, and you can see the lower highs that's converging into a hinge, and it's already come out of that hinge on very high volume, wide-ranging spread, closing near the highs of the range. And if we can now consolidate in this area and then just keep going to the higher resistance areas, this could very well be the completion of accumulation.
So which is around like 120 to 140, those kind of areas right there for the new resistance areas.
And so now this is something that we can circle back to in a later episode, but we would do point figure analysis of this structure. And point figure analysis gives us a way to be able to estimate how much price potential there is in the appreciation of the stock if it can jump out of this accumulation area. And that's a very cool tool, totally old school, been around forever. Not many people know how to use it.
Right.
I'm trying to revive it, talking about it, writing about it.
Yeah.
And so we'll come back and do point figure at a later date.
And that's perfect. So right now, Polaris is trying to get out of a longer term trading range right here. And it has on Mark Smith with the pattern recognition formed a consolidation that it's right near the pivot on that area. And if it gets to that, it could start a new uptrend here.
And we have a big point figure count.
And you have a big point and figure count. That could lead to a more significant move in the long run. Now, Bruce, one thing I learned from you years ago, especially when you're using these point and figures and getting these large counts, is when they started to move, you would react with glacier-like intensity, right? You would really hold for that longer part of the move because you had that count and you're going more for that projected move.
Well, that's exactly right. I am a campaign trader. I'm looking for stocks that I can campaign for big moves that can go for long periods of time. So that's my nature. That's what I like to do. But also you can use point figure on a much shorter term time horizon, and you can trade for the much smaller swing trading moves. And I love to do that analysis. And I also do a lot of intraday point and figure analysis. And that's a lot of fun. And so I tend to do all time frames, but I'm primarily a campaign, call it investor in my work. Perfect. Because I'm trying to be consistent with what the objectives of the composite operator are. So where they're going is where I want to go.
Right. Yeah. In the end, you just want to go where the big money's going.
Right.
Let's go to the second stock here. This is Ppg Industries, ticker symbol PPG. And now you can see there's another large trendy range here, and this one's getting into definitely 52-week highs and near all-time highs, it seems.
So this is just a classic example of a high-level reaccumulation is what we would call this. And notice on the left side of the chart all the volatility. So you can see big declines, big swings up, big declines. This is what we were talking about with phases.
Yeah. Is
that the early phases of an accumulation or reaccumulation area will behave differently than the late phases. And I can show you an example in this very chart. And this is why patience, Wycoff lends itself to us having patience. So you can see all the white swings on the left side over there. And it's very volatile, up and down, up and down. Well, look what happens as we get over to the right side of the reaccumulation area. And notice how these declines are becoming ever shorter in duration and also less intense in terms of how much they're declining. So you can look back in really in 2019 and look at each of the declines is less than the prior decline.
Yes.
And the most recent one, it basically just went sideways. and consolidated that area and then jumped right out. And so these are the things that we train our eye to look for in the chart, is we look for the change of character on the right side of the chart from the left side of the chart.
And going from that volatility where large bars, if you're looking on a bar chart, and then they just start tightening up more and more and more, meaning that less eyes are watching it at that point, and there's also less shares for sale.
And get this, on the left side of the chart is where it's easiest for the composite operator types to build their position.
Interesting.
Because there's so much fear associated with the volatility and the steep declines.
Yeah.
They can buy stock on a scale down towards support, and they can buy lots of stock. On the right side of the chart, where you have a series of higher lows and diminishing volatility, they're having a very difficult time buying the amount of stock that they want to buy.
Yeah, and that's an important concept. It doesn't matter if you're following Wyckoff, O'Neill, if you're looking at point and figure charts or bar charts. Recognizing that volatility shift, going from volatility to really start to see bases, tight action, and short bars, that's telling you everything that you need about if the stock's being accumulated or not.
Well, and Wyckoff and O'Neill both are methodologies that really help us to have the patience to wait for these completions.
Yes.
And that's the key. We're working in methodologies that help us to seek the right moment. And that's where mastery comes in. We're attempting to develop mastery. So
that's perfect. Let's go to the third stock here. This is Sonos, ticker symbol SONO. And these guys, they make a lot of audio equipment for the homes, a lot of those speakers. And kind of the wireless speakers that are attached to the TVs and all that kind of stuff. They're a newer IPO from 2018, and they're going through that accumulation process too, it looks like.
Well, this is a small little company, and it's interesting because it's going through a cyclic distribution, markdown, climax, accumulation range, attempt to jump out, and now it's backing up. After jumping out of its accumulation area, it's backing up to the top of that accumulation area. And I use the term IPO disease. This stock has the IPO disease. And it's actually a good thing. I actually believe that the composite operator types love to see these IPOs come out, go public. They're good companies, and then they just swoon. They just go into these big cyclic declines.
And they almost take like a year to 2 years to form these kind of large bases where these composite operators or institutions can start accumulating those shares.
Right. And so they're buying at a value point. You can see the climax, the automatic rally. You can see the outer boundaries of resistance and support as defined by those two simple points. And then there's attempts to go down in Sonos and diminishing volatility on each attempt to decline in the accumulation area. Finally, there's a little bit of a spring. That's a term we use in Wycoff, where it springs a key prior low, goes below it, declines below the area of the key prior low temporarily and can't hold below it, and then turns really sharply. And that's exactly what's happened with Sonos.
And that was around August of 2019, right? It looked like during the summer, it could not sell off lower than $10. And then it just kept tightening up, undercut $10 one last time. And if you look at this on a weekly chart, then definitely pull it up and take a look at it on a weekly chart. On the week of August 9th, you see it go below $10, and then bam, you see that spring kind of go right back up well above $10, almost at $12.
Huge outside day, and it just begins a nice run up and out,
right, which
is evidence of absorption being complete. And so we have evidence here in this little company. This is not like the prior two great institutional, industrial type companies that have dividends and have been paying dividends a long time. This is a little emerging company, but it could very well have a tremendous growth story. And so now we have it up and out, and it's backing up. Well, notice how when it's backing up towards the old resistance area, which is now support,
that's around
that
the $12
volume is drying
area.
up.
Yep, it's around the $12 area, and now volume is drying up, and with the Mark Smith pattern recognition, it's starting to pick up a consolidation there.
And when volume dries up on the decline and you have diminishing volatility in the price bars at the same time, that is a classic clue that the stock is tired of going down. There's no supply of stock available to be bought. It's just resting at these areas, and that if we can now get another pivot up here off of this old resistance area, which is new support, that it could be the beginning of a good uptrend in the stock, or the emergence of an uptrend.
Yeah,
and it's got a nice point figure chart that goes up to into the low 20s just on a swing trading basis.
Perfect. And so for those of you, when you get back home, pull up a Mark Smith chart, look on the weekly chart, and look at really most of October and the end of September, and you'll see how the weekly bars really get tight. And then look at that weekly volume. There's not a lot of trading there. It's very, very quiet, and this is why Bruce is saying that it's getting tired of going down. There's no more selling at that point, and so now it is set up, if you get that catalyst, to break out higher and move on to 14 and could even project up to $20. So there are 3 stocks to consider during this market. Definitely add them to a watch list and do your analysis. But remember, patience and waiting for the right moment is everything in investing. Have that plan your trade, and trade your plan. Thanks, Bruce, for joining us today.
Oh my gosh, it's a thrill to be here. And I am starting in the process of developing a newsletter that's going to be oriented towards these types of stocks. And it's going to be stocks that produce not only the growth potential that you can define with point figure charts and Wyckoff, but also they have income characteristics. And if anybody's interested in being alerted when the letter becomes available, they can email me at bruce@highgrowthincome.com.
So that's bruce@highgrowthincome.com, right?
Perfect. And just send us an email, and as soon as this is ready to go, we'll get back to you.
Excellent. We're definitely looking forward to seeing that. So that's it for this week on Investing with IBD. Next week, we are going to have Tom Dorsey on the show. Now, Tom is the founder of Dorsey Wright, and he sold his company to NASDAQ a couple of years ago. Now, he's one of the legends in the technical analysis world, and he, too, like Bruce, is a big point-and-figure chart fan and really has spent his life trying to spread the word of point-and-figure and relative strength. So that's it. I'm Marusha Pierce, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.